Now, Kenya will need to implement a raft of measures, including reducing the cost of energy in order to grow its export earnings and cut down on its huge deficit. On the first day of the third edition of Kenya's Trade Week, leaders emphasize on the need for export diversification and value addition if the country is to narrow the huge gap between what it buys and what it sells to other countries. Victor Kiprop with the details.
Over the last 5 years, Kenya has performed poorly in matters international trade, consistently importing goods worth nearly triple what it exports. This dismal performance has always been attributed to a number of challenges, including lack of market access and diversification, and the low value fetched by the raw products it exports.
Our exports grew from 537 billion in 2014 to 613 billion in 2018, indicating a 14% rise. However, during the same period, imports went up from 1.62 trillion in 2014 to 1.76 trillion in 2018.
But while value addition has been touted as one of the solutions, the same will not be achieved without adequate investment.
We must do value addition to the minerals and other commodities that we produce on the continent. To do this, you need a lot of energy. At the moment, the energy is too expensive in this country. At 16 cents per unit, you cannot be able to compete effectively internationally.
Under the Integrated National Exports Development and Promotion Strategy, Kenya has set itself an ambitious target, that of growing exports by 25% and achieving trade surplus by 2022. But with only 3 years left, the big question remains, is that target still realistic? Kenya is looking at the recently effected Africa Continental Free Trade Area market and investments in key areas such as manufacturing, agriculture and fisheries to turn around its international trade fortunes. Victor Kiprop, NTV Business.